This is Introduction to Key Trading Terminology, brought to you by the Falai Trading Academy, where we trade smart and invest better. My name is Ade Falai. We'll start with bull and bear markets. A bull market is a market condition where prices are generally rising. So you see that the price of this candlestick, or the close of this candlestick, is lower than the close of the next candlestick, and you have consistently higher price with each close. In a bear market is a market condition where prices are generally falling, so the opposite of a bull market. So as you can see, each candlestick has its open and close below the close of the previous candlestick. So this is the open and close, open, close, open, close. So when you have a series of bearish candlesticks where price is closing lower than the previous low. Pips and points. Pip, which is percentage in points, is the smallest move in a currency pair and is represented by 4 decimal places, 0.001 for USD pairs, except in Japanese yen pairs where it is 0.01. So in non-Japanese yen pairs, if you're moving from 0.0001 to 0.0002, with Japanese yen pairs, it is 0.01, and a movement in price would be to 0.02. So there are only 2 decimal places with the Japanese yen pairs. Points, which applies to index and futures, is the smallest whole unit move in an index or a future contract. So for example, 1 point on the S&P 500. Bid and ask price. The bid price, or buy, is the highest price a buyer is willing to pay, and the ask price or offer is the lowest price a seller is willing to accept. You can see on MT5 on the top left hand corner of the charts, if you click this tab, it will show you the sell and the buy price, and you can see the sell price in this example is 1.0327 and the buy price is 1.0329. Spread. Spread is the gap between the bid and ask price, and this is something you need to factor into your trading costs. So a wider spread can increase trading costs, and a narrower spread is generally more favorable for traders. Highly liquid assets usually have smaller spreads, making them cheaper to trade. Margin and leverage. Margin is the amount of capital required to open a leverage position. Leverage allows you to control a larger position with a smaller amount of money. So you can have a 1-to-100 leverage, which means you control 100 units for every 1 unit of your own capital. So if you have £1 and you have a leverage of 1-to-100, effectively you're trading £100 with £1. Key point to note with leverage is that leverage magnifies both profits and losses, and you should use it responsibly. If you have a 1-to-100 leverage, losing 10% will lead to 100% loss on your account, so you have to be very careful. I'll recommend only risking 1% if you do have such a high leverage. I tend to only use 1-to-20. Stop loss and take profit. Stop loss, or SL, is an order to exit a trade automatically when price moves against you. Take profit, or TP, is an order to lock in profits automatically when price reaches your target. Key point to note with stop loss and take profit: setting stop loss and take profit helps you manage risks and emotions in trading. Support and resistance. Support is a price level where downward movements tend to pause due to buying interests. As an example, you will notice that whenever price or candlesticks get to this level, a bullish candlestick is produced immediately after. Same again on this instance, and on the third time the bullish trend was established. So this is an area of support. Resistance. Resistance is a price level where upward movements tend to pause due to selling interest. Resistance is the opposite of support, and as you can see, whenever price gets to this level, it's rejected, the level is tested again, rejected, and again, and again, and then the downward trend is established. Key points about support and resistance. Traders often look for breakouts or bounces around these key levels. So a trader might decide to buy in an area of support or sell at an area of resistance. Volatility. Volatility is how rapidly and widely prices fluctuate. High volatility means larger, faster price movements with potentially higher reward, but also higher risk if it goes against you. Low volatility, smaller, lower price movements. Key point to know about volatility: you need to match your strategy to the current volatility to manage risk effectively. So if volatility is reducing and you're in a trend, you might consider either reducing your risk by moving your stop loss or closing your trade and re-entering with a smaller lot size in case the trade goes against you. Liquidity. Liquidity is how quickly an asset can be bought or sold without affecting the price. High liquidity leads to tighter spreads and easier trade execution. Low liquidity leads to wider spreads and potential slippage, and there tends to be low liquidity towards the end of the market. So if you look at certain charts within the last hour of trading, you notice that there is wider spread. Key point to note: major currency pairs, for example Euro USD, and large cap stocks usually have high liquidity and lower spread. Risk reward ratio. The ratio of potential profit reward to the potential loss in trade. If your potential gain is 2 times your risk to reward ratio is 1 to 2. Final thoughts: mastering these terms is crucial for risk management and strategy development in trading. Be consistent in your risk management strategy, no matter what instruments you're trading. If you've enjoyed the video, give it a like, and don't forget to subscribe to get notifications on further videos in the playlist. At the Falai Trading Academy, we trade smart and invest better.